Hi students, and welcome to Accounting 2120. This video is going over Chapter 11, Individuals as Employees and Proprietors. So individuals earn business income as employees or through self-employment. Self-employed individuals are commonly referred to as independent contractors, but are also described as freelancers, external consultants, micro-business owners, entrepreneurs, proprietors, or individuals who work in the gig economy. So in many cases, properly categorizing individuals as employee or self-employed for tax purposes is complex. So this chapter with the discussion of the factors that must be considered in determining whether an individual is an employee or self-employed. This is followed by a discussion of tax provisions applicable to employees, and then by a discussion of tax provisions related to self-employed individuals. Let's talk about employee versus independent contractor. Person or self-employed or payroll, basically serving, like performing. Okay, then you contractor. Employer's perspective, misclassification of individual as self-employed rather than as an employee is not uncommon. The set of rules related to employee versus if you're instead of as an employee, like employee, unlike programs, employers are not in Medicare, categorization as an employee as such. With self-employment, individual assumes responsibility for employment with performing the job. Is a independent contractor gets paid separately. Generally, taxes are not withheld. And what happens is instead of receiving a W-2 showing the amount of wages that you were paid during that tax year. So when you receive a 1099, you're responsible for making sure that you report that on as your income, and you have to pay taxes on it. If you are on their payroll and you're considered an employee, then taxes on how much taxes were withheld, and you'll use that information when reporting your taxes to the IRS. So factors considered in classification. Okay. All right, visual as independent contractors, like common law, and is summarized in 20 factors that contractor that's self-employed. So let's go back up real quickly. So we'll go ahead and go down here. So a common law employee-employer relationship, and the ways in general this means that a work could be done and how it likely does not exist. So if this company has rules and procedures and you're performing a job and you have to stop, then and you're unstreamy, based on following those policies and procedures of that company, you're given a job, but then you're not managed or monitored on how it's done. Then you're usually a self-contracted or self-employed. So co-worker, a common law employee-employer relationship likely exists. Furnishing tools or equipment to help you do the work, making training available to provide needed job skills, allowing participation in various things for services based on time rather than the tax performed. Contractors are more likely to have significant investment in their business relationship than work and make their service on a per job basis, not on a time basis. Are available. These include income from discharge or debt available only to individuals in fellowships, compensation for injuries and sickness. Another class of, and these are referred to as your fringe benefits. Fringe benefits is attributable by employers and therefore excludable from income by employees. So let's just look at an example with this talking about 21%, which is common for corporations, provides health insurance coverage to employees at a cost of $1,000 per employee. Because Cardinal coverage, the net cost to the corporation is about $790 per employee. $1,000 cost excludes the value of this fringe benefit from gross income, so there's no tax cost to the employee. Sponsored accident employees, retirement benefits, disability insurance, and long-term care, and they're excluded from the employee's gross income. So these are more examples of some of those fringe. Well, at least I consider more examples of benefit. It excludes payments received from, or if the payments are for expenses that do not meet that already. The amount received is income, any amounts received from medical. If you reported it as an expense and received a deduction, and then in 2020 you got reimbursed for that expense, then you have to report that expense. So we are excluded from income. So instead of providing the employee with any to reimburse the employee for these expenses, the benefits received under a self-insured plan can be in favor of highly compensated employees. There is an alternative medical insurance plan with a high deductible, and then employer can make contributions each month up to a maximum of 100% of the deductible amount, under to 1/12 of $3,550 for family coverage. I think the deductible amount is limited to 1/12 of 7. So meals and lodging. The value of meals and lodging is excluded from gross income. So meals and or lodging are furnished by them or the convenience of the employer. So from 2018 to 2,000 of the meals. So it is a that provides some of the cost of meals. Law is extended. Okay, if the employer continues to provide such meals, their value is going to remain as an exclusion. They are excluded from gross income. In the case of lodging, the employee is required to accept the lodging as a condition of employment. Okay, excluded from gross income. So, what does it mean by furnished by the employer? Who is considered an employee, and what is share some more understanding. The IRS's exclusion does not apply to a partner of appeals have held that a cash meal allowance employer do not actually furnish the meal where you're paid for food and supply the goods facilities, but the employee prepared the meal. So on the meals and lodging as resulted in much litigation. This is just some fun, interesting information. The regulations define business premises. However, the tax court considered an employer managed by the taxpayer can be the employer. Okay, employer's motivation for furnishing the meal. If the employer furnishes the meals and lodging primarily to enable employees to perform their duties properly, required as a condition of employment. This also has to serve the convenience of the employer, but the employee is not required to use the housing. The exclusion accepting a benefit of cash or lodging, the conditional employment test is not satisfied. So can claim a limited exclusion for group term life insurance benefits that are provided by an employer. The premium are excludable from the employees and the former employee's gross income. So the benefits and partners are not considered employee satisfies the group requirement constitute a group term insurance protection for a period and not to ordinary life insurance. Now, the exclusion applies to the first $50,000 of coverage in your gross income. As employees with a group term annual salary. So Keith, a salary of $350,000. Keith must include $828 in gross income related to their annual salary. Subtract out the $50,000. Then you divide it by $1,000. Okay, because for each $1,000 of coverage in excess. Now here is 54, and so 3 cents. That's per month. So then you take his salary, subtract it, which is 50,000. So because you have to pay premiums for here to this table, 23 cents up to 23 cents. He has to include that in a year. Again, life insurance, just group term life insurance. Institutions can exclude from a qualified tuition reduction plan. So the exclusion applies to tuition reduction at children. So if you work for college and the college offers a tuition reduction or waiver for you, your spouse, or your child, you don't have to report that as gross income. It's excluded. So certain other, we'll just go through these really quickly. Just his income, the value of child, and encourage to enable the employee to work, or other athletic may be excluded from a membership to be in that gym. That's not considered income, so that would be excluded. After taking a trip that the employer paid for, no gross income is at the undergraduate and graduate employer for you to further your education towards your tuition is I read that right. If an employer up to 14,300 of options is paid or reimbursed by the employer, so that would not be reported as income or adoption expenses as well. So that's very interesting to get that out the same. Well, all of those were just that the employee is not required to report as gross income. Another one is cafeteria grants. Those compensation the employee is deemed to have received the cash, even when the non-cash option is elected. As a result, the employee recognizes gross income if you are, offered some sort of, if it's compensation. So if which one you choose, you have to report the value of that compensation as part of your gross income. There is an exterior plan rules. So such a plan it chooses the benefits to be excluded from tailoring the employee prefer cash, while others will opt for the Fringe Benefit program and be considered a fringe benefit, and you receive the cash value from receiving plans. Okay, he accepts yours agreement to pay. So assume that the employer's health insurance policy does not cover a dental expenses for the upcoming year and agrees to a salary reduction equal to the estimated dental expense employee for the actual dental expense. If the employee's actual dental expenses are less than the reduction in cash compensation, the employee cannot recuse or lose plan. To avoid the loss of unpaid amounts, the IRS allows a payment until 2.5 months, which can count towards the Proprietors plan. So here's some examples of employee fringe benefit table to look at. It really just kind of summarizes it all up. It's to its employees under the all-inclusive provisions previously discussed. specifically include resulting gross income is the fair market value. This can lead to results that are employed in New York as a ticket clerk for and has no money for plane tickets. Transnational has day seat. The cost of a round trip ticket is $400. If Transnational allows Ryan to fly without charge to Miami under the general to the value of the ticket. Now, because Congress really it's the stats that include discounts, working as qualified moving. The value of the circumstances that are not discussed next. So the non-localities a little bit. But the main thing I want us to look at is benefits, option meal cost results. It established broad classes of broad classes of non-taxable employee benefits. And these are excluded from the employee's gross income. So example 9, with Ryan fly additional cost service fringe benefit. Okay, employees gross income to services as opposed to including foregone revenue. Are all so obviously all of these were met. So for Ryan to fly taxable income under the no additional cost service. So let's look at example 10. And now and more fuel because Ryan is on board. Ryan may receive the same meal or snacks as paying customers. The additional costs to the airline are not cost service, and the value of the flight would be excluded from Ryan's gross income. Or foregone revenue, Ryan's gross income. So you see the difference. Service because it had, regardless of Ryan's or not, revenue for Ryan to take up those seats. Now, if that seat was reserved for Ryan, thus preventing a paying customer, therefore not meeting the test for a no additional cost service. And qualified employee discounts. A lot of times when you work for a company, like a retail company, you get discounts of goods or services to the employee for prices less than price charge to regular customers. You get that employee discount. So in a subject to the following conditions. Okay, the exclusion is not available for discounted sales of real property such as a house investment, such as common stock. The property or service and a component of the price to 20% of the customer. So this is property or services provided by an employer if the employee could deduct the costs are called working condition fringes. So Mitch is a CPA. Mitch's annual dues to the payment of the dues in his gross income amount as an employee. De minimis fringe. These are some of the de minimis fringes. Occasional company cocktail parties or picnics for employees. Occasional money for meals. And notice a common term, occasional. Okay. There is obviously room for disagreement as to what is de minimis. So according to the IRS, generally the value of personal use of an employer provided cell phone is excluded as de minimis fringe benefit if the employee to be in contact with clients when the employee is away from the office. We have qualified transportation fringes, use mass transit for community and from work. Moving reimbursements are all examples of broad classes of non-taxable employment benefits. In this section, payers, a worldwide system, all income system, a U.S. system, the same income would be taxed in the United States as well as in that other country. Since from working abroad, Congress is on foreign earned income on his or her taxes paid, or the foreign earnings from his or her income exclusion. I believe, the later chapter, foreign earned income consists of the earnings from the individual's personal services rendered in a foreign country. It is often referred to as an expatriate or an expat. To qualify for the exclusion, the taxpayer must of the foreign country or countries present in a foreign country countries for at least 330 days apply in calculating the exclusion and tax owed. The exclusion must be computed on a daily basis when the exclusion period straddles 2 years. The tax on the income in excess rate, they would apply. Some examples. Encompasses the following dates. In February 2020. So during the 12 consecutive months ending on March 10th, 330 days. Therefore, all income earned in the foreign country through March 10th, 2020 is eligible for the exclusion. The exclusion amount of $107,000 both of whom have foreign income in the tax year are not exclusion on a daily basis for days in the entire year and multiplied by the number of qualifying days. He qualifies for the foreign income exclusion. He was salary for 2020 as 120. He can exclude now assume qualifying days. 2 days and divide it by total number of days in the year, we'll just assume 366, the multiple exclusion amount, and that equals the $100,544 exclusion allowed. Lastly, we'll talk about example 17. Carol, after excluding $107,604 earned income. Without the benefit of the exclusion, Carol's taxable income would have been $137,000. $30,000 is calculated using the marginal rate applicable to income between $107,600 and $137,600. Liability is $7,200, which is 24% of the $30,000. Now, expenses that are ordinary, necessary, are deductible in the calculation of taxable income. However, this is by all taxpayers without limit. Let's talk about transportation provided by from gross income. Next, we're going to talk about deductible, unreimbursed employment-related taxpayer from one place to another, and of course, not away from home and travel status. So now, deduct unreimbursed, having to commute from like certain area, maybe, and you have to drive to each site on a regular basis using your own personal automobile or a tax or whatever. You have to be tolls, you have to be parking, etc. And these expenses tend to be deductible. Most employers, however, if require you to do that sort of travel for job during working hours, do offer some sort of compensation for that. But if not, then you can deduct those expenses. An example would be, because it says here, like going from home to work is not, this is when you're traveling during work. So and that have to travel. So what happens is A to point B. So if you be your home address and you went to your normal place of business, which is the Griffin campus, so you would plug that in as waypoint B. But then you have to finished teaching the class at Henry campus, and you have to come back to Griffin campus to teach and then you could log in A. So from A to C and C school. So that round trip there and that hours, and then you had to return back to the Griffin campus during working hours. All of those miles that you had to are reimbursed by the college, or if it's not reimbursable by your business, you can deduct that as a business transportation expense. But the miles from home to that is not a reimbursable or deductible expense. You have actually two choices. So the first alternative is oil repairs license and insurance costs for personal and business purposes, only allowed as a deduction. The second standard mileage method. So the deduction is based on a mile. So as we just talked about, the Henry campus reimbursed, you wouldn't get reimbursed, and it's about 7.5 cents per mile. So travel expenses are more expenses include transportation. Meals cannot also include laundry, and any kind of lodging is available only at the taxpayer's home requirement. The crucial test is overnight. Overnight need not run than an ordinary day at work. A lot of assignments, the taxpayers must be away from home for a temporary period if their new location becomes their tax home. Okay, so really short period of time. So I would say like 6 weeks would be considered like a temporary assignment. But they are for home. So determining a tax home, ordinary circumstances, determining location of taxpayer home does not meet a problem, but the tax home in more than one place of employment, tax home is determined by considering the time spent. So how much time you spend each place. So if you're one of those persons like that, what is your tax home? Well, where did you spend the majority of your time? Not reimbursed by your employer. Okay, that's key. Not reimbursed by your employer. Can be a taxpayer can deduct requirements to keep his or her retired in the present time, educational purposes to meet the minimum job, or due to qualify the taxpayer for a new trade or business. So one of this is that it is unable to meet the minimum standard. Deduction for qualified gross income is allowed for qualified tuition related expense, modified gross income, and filing expense. So in general, single taxpayers with one grade with are married is 130. 4,000 applies at the maximum between 65. I really wanted to understand that various aspects of qualified tuition and related expenses include whatever was required for enrollment. So these are like any kind of student activities, books, room and board. So it's whatever is required for enrollment. The expense need not be employment related, although it can be. The deduction is available for married persons who file separate to avoid adult provisions. No. So if you're a dependent, your claims. For the adjusted gross income deduction classification avoids the non-deductibility of miscellaneous itemized deductions. So the deduction for qualified tuition in 17, which is a tuition and fees deduction, and filing it with a 1098T, which is a tuition deduction. Next, per entertainment and meal expenses is often involved in activities. As a result, Congress expect to an activity considered to be entertainment. Deduction for membership dues or deduction is allowed for a facility or a portion thereof used in connection with any of the 3% rule has a number of exceptions. So this is associated with operating a trade or business. But the one exception covers the situation where the full value of the meal is included in the compensation directly related to business meetings of employees are not subject to the 50% rule. And a similar exception applies to employer paid recreational retreats and or other off-site training events are generally allowed to deduct 100% of these meals provided to participants at those sites. The office and the home expenses in proportion as either the principal or customers. Now from 2018 to 2025, employees are because these expenses are considered miscellaneous itemized deductions. The precise meaning of a Principal place of business has been the subject of debate since principal place of business includes the following requirements. The office is a trader business where the taxpayer conducts these activities. Many teachers pay for professional development courses or purchases first by their employer, so such expenses could be considered miscellaneous itemized deductions. However, the deduction for those amounts is currently set. There are classifications on whether they are reimbursed by the employer under an accountable plan if such expenses are reimbursed by the employee. Simple as that. That's under the accountable. A non-accountable plan is a plan in which an add is not required. So all expense reimbursement is W-2 and you are deductible in the same manner as unreimbursed. The business expended as miscellaneous itemized deduction. So is not a tax. The owner reports the results of the business operations, the net profit or loss reported on the proprietor. So income proprietor. So an example, or when reported by the proprietor, as capital gain when reported by the proprietor, so on and so on. So it is not as a proprietorship. So proprietors may choose among various accounting method and the accrual method or a hybrid method. Income and deduction applies equally to individuals and business entities, including proprietorships, corporations, and partnerships. Thus, asset inflows into proprietorship are to be treated for the income. So self-employed for adjusted gross income employment tax, the Medicare benefits, $400 or more from self-employment tax is 15.3% of self-employment income up to and 2.9% of self-employment in excess of 137.7, which is usually Medicare. Now, net earnings from self-business less allowable trade or business deductions, partnership income or loss. So in the contractor, so these are all considered net self-employment earnings are reduced by employer's tax. So basically what that's saying is your own taxes, but then your own employee, Social Security and Medicare, self-employed paying 15 point. Now the portion you paid as an employee, is considered a deductible expense. Retirement plans applicable to both employees and self-employed individuals. Other options for self-employed individuals include, but are not limited to, HEOG plan. Self-employed individuals can establish and receive qualified retirement benefits under the HEOG plan. Self-employed individuals under the plan. Employers with a qualified retirement plan for employees, form of a 401k or an IRA. Deductions for part of the Internal Revenue Code. The rationale for the corporate tax rate 21 level reform is compared to the double taxation experienced by businesses for the deduction for the QBI. So assume that a corporation has $100 of taxable income in 2020. If that corporation distributed all of its maximum combined 37%, that the corporate would distribute, for an example, a dividend would be taxed at the max $10. And the remaining after-tax income equals $63. This means that a combined 37 business income. And that same $100 in the highest income tax amount of 37%. Thus, without the deduction of the QBI, eliminated by 2017. So the deduction of the QBI is equal to 20%. So by allowing a 20% deduction, the maximum tax rate on non-corporate business income is approximately 30 rather than 37. Example of basic QBI deduction computation. Sanjay, a married taxpayer, operates a candy store as a sole proprietor to customers. In 2020, Sanjay's qualified business income is $210,000, reduced by his self-employment is $274,000 by his spouse, but deduction for income is $250,000. So Sanjay lesser of one or two. Okay, so you either take 20% of the qualified business income, 10% of the modified taxable income. So you take the lesser of the two, $8,000, which $250,000 of PBI deduction. Look at another example. Assume that ownership in 2020, her business deductible expenses, income from her business deposits is $102,400. Abby has $100,000 minus her deductible expenses of $40,000. Okay, her modified taxable income is $90,000, which is $102,100. Now, Abby's QBI deduction is $18,000, which is the lesser of 20% of qualified taxable income. As a result, Abby's taxable income is $72,000, $90,000 $10 QBI deduction. So for the census, Expenses incurred by that the activity was entered into for the purposes of making a profit. Difficult to determine if the primary motivation for that. Examples include raising horses as a weekend residence. So while profit-seeking activities may be deducted and used to often profit-seeking motives are classified as hobbies and the taxable. An individual so losses from that activity are fines only if the activity is not engaged in for profit. Hobby expenses are deductible only to the extent of the hobby income. Now, the regulations stipulate that the following 9 factors to be considered a hobby. So whether the activity is conducted in a business-like manner, the expert expended, the expectation that the assets of the activity will appreciate in activities, the history of income earned to losses, the financial status of other income. This may indicate that, and then you have elements of personal pleasure or recreation. It is not by itself a hobby, where the decision is a subjective. The code provides a activity to shows a profit and involves horses a profit, and at least 2 profitability tests are that the activity is presumed to be a trade or business revenue. Only to the extent of the gross income of the hobby. So these expenses under the code sections without regard to the nature of the interest. Okay, so now in for profit, but only examples include maintenance, amortization, and taxes and mortgage interest are deducted. So from 2018 to 2025, any other hobby expenses are not deductible, but the revenue from the hobby is included in gross income. So let's look at an example to get clarification on this. Income of $80,000. She paints in her spare time. She uses a home studio. Here, Jane incurs the following expenses: frames, art supplies, fees paid to models, and then her home studio expenses. $1,660. If the activity is a hobby, Jane is allowed with the $8,660 as gross income, percent of the total focus to mortgage interest deductions, thus giving her a net income from her hobby of $7,460. 11, we hit on some point, read the chapter more in depth, really look at those examples. I urge you to do that. But that includes